Hey, good afternoon, everyone. I really appreciate you giving me my time, giving you your time. Um, I just want to tell you a little bit about myself. My name is Mark, and I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I have many published articles in the literature, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. And in my college and graduate work, I was involved in the optimization of software systems, and for the last 10 years have brought that past training to bear on the financial markets, and this is what gave birth to Right Line Trading. What I did in my graduate work was look at every single closed system as described by a series of independent variables, and by determining just what those independent variables were and placing them in a multivariable equation and optimizing them, you can then predict how this closed system is going to work. In the financial markets, we're looking to predict the future movement of price in any given financial instrument. Now, there really is a big problem with current technical analysis, in that 95% or so of day traders fail to make any money, and a very, very large percentage of day traders wind up losing their account. And this is unacceptable in any other field of endeavor. If this was a field of architecture, or the field of medicine, the field of electrical engineering, any other field, that 95% failure rate would just not be acceptable. But yet, for some reason, we tolerate it as day traders. And the bigger problem is that this number fails to improve over time, which shows that there's something inherently wrong with this field of endeavor. I mean, there's no evolutionary process taking place whereby one group of traders find out what's working or not working, and then they pass that information on to the next generation of traders, such that each generation of subsequent traders simply trades the same methodology, the same indicator analysis, the same patterns that the prior generation traded that caused them to go bankrupt. And the problem is that everybody simply accepts current dogma without any kind of mathematical verification. Some self-professed guru will get up there and tell you what works without validating it scientifically / mathematically, and sell it to you, and it winds up not working. Now, if you do a LexisNexis search of the world literature, you'll find that there's very, very little, if any, because I found nothing, no well-performed scientific / mathematical analysis of the precision of indicator analysis or technical analysis in providing traders with a mathematically precise entry that allows them to make money. Everything we trade is done by the seat of our pants. And all the information that we have is simply information that's been handed down to us by the prior generation of day trader. There's really not a whole lot new. People have been trading Fibonacci numbers and Fibonacci support and resistance forever. They've been trading Elliott wave forever. They've been trading oscillators forever. It's not created wealth for any prior traders, and it's not going to create wealth for you. What you have to do is look at really a new trading paradigm. And our basic course is really geared to sort of reprogram you, to erase your memory of all the concepts that you've been taught, and to fill it with information that we have verified as being mathematically accurate, and to really provide you with really precise trading entries. Now, the first thing I want you to think about is your trading strategy. Now, a trading strategy is simply not based on, again, seat of the pants type of analysis. There's a sensitivity, there's a specificity, and there's a positive predictive value associated with your trading style, your trading methodology, and your trading entries. And unless you understand what you're doing, you're not going to get to profitability. And I want to give you an example, and we go into this a lot in our basic course. If you trade with sensitivity, we're not really going to go into the formulas here, but I want to go into what the formula for sensitivity and specificity represent. Now, if you trade with a high degree of sensitivity, you're looking to enter into every potential winning setup. Now, because of the formula, it's axiomatic that you're going to pull in a lot of losers. It's an absolute mathematical mandate that if you look to get into every winner, you're going to wind up also getting into a lot of losers. Now, if you trade with specificity, you're looking to avoid every potential loser. Now, if you do that, it's going to prevent you from getting into some winners, but this is the way we have to trade. We have to trade with it. Our trading methodology has to be a trade-off between sensitivity and specificity, such that our main goal is to look to avoid every potential losing setup. Because almost every day trader can grab winners. What most day traders cannot do is avoid losers. So the greater degree of specificity that you can trade with, that's the amount of money that you're likely to make. And that has to be your underlying core goal. It's not so much to get every winner, but it's to try your best to avoid every loser. And that's the kind of trading dogma, the kind of trading methodology, the kind of analysis that you have to do to avoid taking losers. Now, ultimately, the positive predictive value is really the bottom line, and that is your win percentage. If you take 100 trades and your positive predictive value is 90%, you're going to get 90 out of 100 winners. If the positive predictive value of your trading style and your trading methodology is 80%, you're going to get 80% winners. Now, as I said, the positive predictive value is dependent on the sensitivity with which you trade, over the specificity with which you trade, times prevalence. And prevalence is really important. And for trading, the prevalence of a successful trade occurs greatly in the presence of a trend. If the market is not trending, the prevalence of getting a successful trade falls off. So no matter how good your methodology, how good the trade-off you have between sensitivity and specificity, if you trade during a choppy market, the prevalence of getting a successful trade is going to markedly diminish, and the positive predictive value of your trading entry is going to fall off greatly. Now, you need software and you need information that's going to tell you when you have a trend. And sometimes that's just simply not so simple. And we're going to take a look at that. And we do a lot of work at defining trend. Now, here's a clear-cut trend. Your short-term moving average is up, your long-term moving average is up, the market skyrockets, and clearly, if you take a long trade here, the entry will depend on what your trading methodology is. You're likely to get a winning trade. And I just wanted to demonstrate how important it is to take a trade during a trending market and not during a choppy market. Now, there are two keys to successful trading. and that is trading in a market that has volume and has volatility. And volume essentially provides you not only with liquidity, but also the ability to move in and out of any financial instrument easy. Now remember that if you try to get into a financial instrument without liquidity, you're going to get slippage on the trade. It does not matter what kind of market you're trading, whether it's stocks, futures, or Forex. It's going to be tougher to get in and tougher to get out. You also want to trade with volatility in which there's a significant amount of price movement. So when markets are moving, we can find great trading opportunities. They can be low risk and they can be high reward entries. Now, potential catalysts to create volume and volatility are earnings reports for a stock, crude inventory report, if you're trading crude oil on the futures markets, FDA reports, if you're trading small biotechs, insider buying. There's a whole host of potential catalysts to give a stock volume and volatility, and that's what we want to trade. And there's a lot of other reasons why we want to trade a high volume market, and I'm going to talk about that in a minute. Now, this is something that is very rarely taught appropriately, and it's most commonly flat out taught wrong, and that is the risk to reward ratio. Now remember, our goal in trading, no matter what our market, no matter what our financial instrument, is to mitigate risk. We're in risk control mode throughout the entire time we are trading. Now, common dogma, and what I've seen in dozens of classes, is that you look for a low risk, high reward trade and then set a desired profit target looking to hit, say, a 1 to 3 risk to reward. So if you risk $1, you're looking to make $3. You risk 50 cents, you're looking to make $1.50. For every penny you risk, you want to make 3. The problem is that that's something more than a wish list. The risk to reward is based on math. It's based on math. It's not a metric you base on what looks good or what you would like. And I'm going to show you an example of that. This is the average true range of this financial instrument throughout any given period of time. Now, the average true range is a reflection of its volatility, or how much movement it's likely to make in any given swing. Now, when the average true range is high, as it is right here, the market's likely to make a big move. When the average true range is low, the market is unlikely to make a big move. So the average true range measures the volatility of your financial instrument. If the average true range, say over 6 months, is extremely high, you can set your price targets high and you can set your stop tight. But there's a formula that we've developed that translates the average true range into a trade management strategy, i.e., what is your initial stop, what is your initial first target, what is your initial second target and or third target, in order to optimize the amount of money that you can make on any given trade. Remembering again that it's not what you like, it's simply what this financial instrument is likely to give you on any given trade. And we go over extensively how to set up optimal trade management strategies. If you don't optimize your trade management strategy and you set targets that are too far apart, you can have your financial instrument make a nice move and not even take out your first target, come all the way back to break even and stop you out. This is a real critical analysis of the instrument that you're trading, and it has to be done based on really precise mathematical analysis. It simply can't be what you like. If you want to trade a very volatile instrument, then you can set big targets based on its mathematical analysis. You just can't do it on your own. It can't be a wish that you want to make $3 for every dollar you risk. If the average true range calculation tells you that the amount of movement on the stock, on a stock, is only going to be about $1.75 or $1.50. So you have to be very careful. It has to be done mathematically. It has to be done precisely. So again, we look at the average true range. The way we do it here is over a year to calculate stops and targets. But from looking at the average true range of a given stock or futures market or Forex market over the course of a year, we've come up with a formula. So you only have to look at a very short time frame of the average true range, apply it into the formula to come up with a really, really optimal trade management strategy. Now that trade management strategy has to be pre-programmed into your dome. If you're trading stocks, it's got to be pre-programmed. You can't set it up once the trade hits. It's all got to be pre-formatted. And stops and targets are not, again, they're not part of a wish list. And I see this very commonly taught. Well, you know, you want a 3-to-1 risk reward. You want a 4-to-1 risk reward. If you try to stretch the trade and it's simply further than the average true range tells you the stock, for instance, is likely to move, you're not going to make any money. We're going to teach you in this basic course how to set up a risk management strategy. Now, trading with volume is something that also is universally taught wrong. It's because nobody ever gives it a second thought. And let me show you the problem in trading with volume. Now, here's a standard volume indicator. It's very basic. It is a standard download on every single platform. It's on NinjaTrader, it's on Thinkorswim, it's on E-Trade, it's on all of them. And it simply provides you with the amount of volume accumulated under any given bar. The problem is that this is the end result of two variables. One of them is the number of shares or contracts or lots that cross per unit time, and the other is the number of bars that form per unit time. So let's say you're in a market and you're trading right here. Well, let's take this low candle right here, and this is an area where the bulls, the power of the bulls and the power of the bears is equal. And so price is fighting here. Now, in trading today, we had candles on the E-mini that sat for 17 minutes without completing one way or the other. And during those candles, a large amount of volume accumulated. So it would look like it's a high volume candle, but it's not. It's just a candle that sat with very low volatility. We don't want to, this is not an accurate representation of volume. A volume indicator should not require two independent variables to trace out a bar. It should be one independent variable. So what we've done is we've created a brand new type of volume indicator. And what we call it is the volume hammer. And the volume hammer simply shows you the number of contracts, shares, or lots that cross per unit period of time, independent of the speed of your price chart. So this is an absolute representation of volume. This moves at a different speed than this moves. And on the right edge, it's telling you exactly how many shares or contracts or lots are crossing at any given time. And what you want to see is a volume spike into the initiation of the move. A volume spike into the initiation of the move. a volume spike into the initiation of the move, a volume spike into the initiation of the move, and then this simply moves on its own, on its own 1 minute or 5 minute or 10 minute, however you set it. Now this is called our volume hammer. And what I'm going to do is, for everybody who graduates from our school, I'm going to give this to you as a graduation present. And this is a very, very unique way of assessing volume, and I believe the only true, accurate way of trading with volume and using it. I'm going to show you how to leverage volume in a really, really unique and powerful way. And we're going to do that also using market profile and volume profile, but together, these are going to provide us with very, very precise entries, leveraging volume appropriately. Now, there's a first step in finding good trades, and you have to know, since 95% of day traders don't make money, that most strategies don't work. And the reason they don't work is the precision of the trigger or the trading entry has not been quantified mathematically. Now, what we know is that price action is critical. And if you look at day trading or swing trading as part of building a 65-story building, and I mean, that's made of all steel and glass. I mean, it is a beautiful edifice. But if it doesn't have a really good foundation, after about 3 weeks, the thing is going to collapse into itself simply based on its sheer weight. And understanding price action is really the foundation. If you can't read price action, you will never be a profitable day trader. And if you look at all the books that are out there, there are very few that are written appropriately on how to trade pure price action. The reason they're not written is that it is such a unique skill and such a difficult skill that nobody wants to put it in a book and sell it for $29 because it's a lot to learn and it takes a lot of time. But every single candle gives you information about the trader's sentiment in the market. And what we have to do is we have to be able to read it. Now, we take 3 out of 10 sessions to learn how to read price action because it's really one of the most critical components to trading profitably. Now, if you want to trade falling and rising triangles, you're gonna go broke. If you want to trade channels, you're going to go broke. If you want to trade rising and falling flags or pennants, you're going to go broke. But if you put them in the appropriate context and understand their limitations, as I'm going to teach you in the class, then you can make trading channels and triangles extremely profitable. But you have to understand the bricks and mortar of day trading, which is price action. Again, we must be pattern traders, but the patterns that we trade have to have a positive predictive value of at least 75%. We need 3/4 of our trades to win in order to make money. And so we need an edge, and we must trade highly precise patterns. Now, I've read Steve Nissen's book on trading price action a couple of times on Japanese candlestick patterns. There are probably 100 or more Japanese candlestick patterns, but there are only a few that give you the kind of predictive value that are powerful enough that allow you to trade profitably. And I'm going to teach you what those are. After 10 years of work, I'm going to show you what I've got, and you're going to be surprised, and it's going to make you money. Now, if you look right here, these are candlesticks. And we're going to go over the types of formations we can trade, but I strongly recommend that you trade candlesticks. Because candlesticks have a high, a low, an open, and a close. And those 4 metrics are really critical parameters to help you gauge market sentiment. When you have this long candle that has 8 cents or 8 ticks or 8 pips of buying power in it, this is a strong buying sentiment. Now, if you look here at this candle, this is a doji. And it's a particular kind of doji. It's a hammer. And what you have to be able to see right off the bat is this is a bearish hammer that the bulls tried to push the market opened right here. Bulls tried to push the market all the way up, and bears were capable of pushing it all the way back down, so it closed right where it opened. So this was a bull thrust that failed, and the market came all the way back to close right where it opened, and the next candle is a down candle. Now, this in of itself is not a reliable enough trigger for you to go short on the next candle, but these are the kind of things that we have to learn to read almost by the seat of our pants without flinching. And when you get these kind of things down, you can really trade with incredible precision. But this is the hard stuff. And this is what a lot of day traders, one, don't want to take the time to do, and two, are mentored by people who don't understand how it works. And that combination is very rugged and definitely goes into that 95% failure rate. We're going to avoid that. We're going to acknowledge how important it is, and we're going to study it over a period of time. And we are going to master it. And when we have mastered it, we will really have laid the foundation for profitable trading. Now, there's lots of different ways you can trade candlesticks. You can trade it as a time chart. A lot of people like a 3-minute and a 9-minute, or a 1-minute or a 3-minute. And I'm not entirely dogmatic about what kind of chart is optimal to trade, but I do have a recommendation. Now, also a lot of people create tick charts or trade tick charts. And there's a lot of information out there that will tell you that tick charts are the optimal chart to trade. I can't really argue strongly against it, except it's not my favorite. Although it's possible to trade tick and time profitably, I think there's a better way to leverage what you see. Now, I just want to say one thing about a tick chart. If you trade a 377 tick, you're going to get a new candle every time there are 377 ticks. Does everybody know what a tick is? Now, a tick has two definitions. It's the smallest movement of price on a futures market. A pip is the smallest movement of price on a forex market, and 1 cent is the smallest movement of price in the stock market. But what is a tick beyond that? If this is trading 377 ticks, what 377 is it measuring? Now, I can't look in the room right now. I have it closed. I'm going to answer questions later. But what I want you to understand is a tick is a transaction. So it's not trading, it's not looking at the number of contracts that cross. It's looking at the number of unique transactions that cross. So if you have a 4-contract transaction that executes at the same time, you've created a single tick. So it is related to volume. Now, the way that I like the Renko charts, I want to mention. I think it is a disaster to trade Renko. And the reason I am so opposed to trading Renko charts is they obliterate price action and market structure. That's what they're meant to do. On all these charts, there's a high-low open close. That's your gauge of market sentiment. How much of a wick is there on a trade? How are these candles formed? You see this big move down, and then a little bit of sideways action, big move down. You can read consolidation and then a breakout of consolidation. You can do none of that on a Renko chart. There is no consolidation. There is no trend continuation. I think a Renko chart is a real quick banana peel chart right into the poorhouse. For some reason, it's got a lot of inherent attractiveness. Now, there are modified Renko patterns that do have wicks. And if you do have a wick, it's helpful. But here's what I believe is the most advantageous way to trade, and go right to the chart. It's a range chart. A range chart creates a new bar after every finite price movement that you set. If you set the range, if you set a range candle at 10 cents, every time your financial instrument moves 10 cents, you get a new candle. You set it at 10 ticks, every time it moves 10 ticks, you get a new candle. 10 pips, every time it moves a new candle, every time it moves 10 pips, you get a new candle. Now, here's the reason why I believe it's the most advantageous way to trade. If you trade a time chart, there's two independent variables that go into the formation of your candle. One is time, and the other is volatility. If the market is extremely volatile, you get a very, very big candle that time cuts off. It's a time-dependent analysis. If you go to your tick chart, it's a volume-dependent analysis. And if you go to a range chart, it is a price-dependent analysis. It requires a specific price movement in your trading chart to give you a new candle. And we're trading price. We have another marker to help us trade volume. So you don't want to trade price and volume. You don't want to trade price and time. You just want to trade price movement. So I think that this is the purest way to analyze market sentiment and market structure. Now, I know that that's debatable, and a lot of people have a lot of affinity for time and tick, and time and tick do work. All I can say is I favor range bars for those reasons, and I would strongly suggest you don't trade Renko. Now, most of the class is going to take place with range bars, but it's readily transferable to tick and time. Now, there are a lot of people in the class that trade time and tick charts and really don't want to change. We'll do part of the class in time and tick. They do give you nice patterns, but I think that range bars give you the best, simply because it's defined by one metric, and that is price. And what we want to do is analyze market sentiment based on price. Now, I sum it up really here. And there's only one independent variable that creates a candle, and that's price movement. In a tick chart, there are two independent variables: price movement and ticks per unit time. And in a time chart, there are two clear-cut independent variables: price and time. So what we want to do is break things down. That's why we don't want to trade volume underneath a candle. We want to trade volume. We want to pay contract stocks or lots per unit time. I think range bars give you the nicest and smoothest way of analyzing price movement. Now, I want to show you a pattern that you can analyze really easily. We're going to spend a lot of time looking at this. We're going to look at consolidation. Now, a lot of traders I've heard say, we don't want to trade consolidation because consolidation is a period where the market doesn't move. And they're exactly correct. It is a period of time where the market moves sideways, but it is a great pattern to trade out of. And it will break out of consolidation the market will break out of consolidation at very predictable times. Now, what is consolidation? Consolidation is when the power of the bulls and the power of the bears is equal. You see, you get a small green candle, you have a doji, and this is a hanging man. Then you get another red candle, then you get a down candle, then you get an up candle, then you get a down candle. Now, later on in the course, we're going to let the system generate our entries for us. But we're not going to do that for a long time. We're going to calculate our own exits out of consolidation based on very predictable formations. And you can see if you trade out of consolidation, you get a great trade. So this is a lot of what we're going to spend time doing, and that is trading price action. And then we're going to add market structure, and then we're going to add indicator confirmation at the end, because that's the easiest part. And we're also going to work on trading with volume. But you can see how powerful it is to trade out of consolidation. Here's another move out of consolidation. This consolidation signal shows the break and the move out. Now, I took these out purposely because this shows what the financial instrument is and what market we're trading. And I don't want that to be important to you, because it doesn't make any difference whether this is Delta Airlines, or this is crude oil, or this is the euro dollar. This formation is relevant on any financial instrument, on any time. So that's why I blocked these out. I didn't want to give you a predisposition to saying, well, this is being taken on the E-mini or on gold or on crude oil. It's not important. What's important is this break of consolidation happens at a very, very predictable time. So predictable that a piece of software can make the prediction and give you an entry and give you a winner. But I want you to know and you to calculate them on your own, and this is what we're going to do, and this is what we're going to work on, and this is what you're going to be able to do when you're done with this class. Again, rising and falling triangles in and of themselves don't work, and trading channels do not work. If you look at a trade scanner that just looks for triangles and channels and you take trades based on these, you're going to get beaten up. Now, there's a lot out there now about high frequency trading, and it is really, really a big problem. You have to watch for financial markets or stocks that are subject to the computer generated high frequency trading. They can blow you right out of a trade because they will send the trade careening in an opposite direction. It is simply the institutional interjection of an enormous amount of volume in any direction that they choose to send it. It is not predictable. It happens at any given time, and you can't time it. You just have to be very careful, and you have to know your customer, so to speak. You have to be familiar with what you're trading, and we know that there's certain markets that are really subject to high frequency trading. We're going to go into that a lot in the course, and we're going to try to avoid those markets. Now, stocks obviously are driven by news. Forex markets are driven by news, and the E-mini S&P 500 is also driven by news. But when news drives a stock or a Forex market or a futures market, it's usually not going to be dominated by high frequency trading. So we look for catalysts to drive the markets that we're trading. Now, looking for these catalysts is not that hard. They happen all the time. But what we have to do is be able to look for these side by side as we trade these financial instruments to avoid getting run over by high frequency trading. And there is a common thread that underlies all commercially driven financial instruments. Those are the instruments that we want to trade, the ones that are predominantly driven by commercial traders like us. And we're going to show you how to find them. Now, what do most other traders do? As I mentioned a little bit, they focus on technical analysis using stochastic, relative strength, Williams-K, which are all oscillators, MACD, which are just moving average crossovers, Fibonacci Elliott wave. And I call these the one more indicator trader. And the one more indicator trader is always looking for that one more indicator that's going to provide him or her with some magic confluence of patterns or signals that's going to allow them to trigger a trading signal or trading entry that's going to make them money and make them wealthy. And the fact of the matter is, it does not exist. The least important component of trading are your indicator signals. First, price action must work. Then market structure must work. Then you look at these indicators for indicator confirmation. And the fact is, none of these work. These have been around for 20 years. Traders have been using Fibonacci, Elliott wave, oscillators, MACD, moving average crossovers, and almost all day traders go broke. If you want to follow in their footsteps, chase these indicators, and they will just take you right off a cliff like lemmings. This is not the way you want to go. And don't be that one more indicator trader, the guy who's just looking for that last indicator to make him wealthy. Now, some day traders scalp volume and look for high of day spikes on any financial instrument. That is another ticket to disaster. Because if you trade a breakout of the high of day, there's no guarantee that the trade will continue. It can fall right back down on you and stop you out. And some day traders counter trend trade using an oscillator. Another disaster. Now, knowing what not to do is just as important as knowing the appropriate thing to do. So bringing these things to your attention are really not time wasters. It's important to understand what you have to avoid. Again, price action trading is the first key to success. The only caveat is that you need good volume. Now, do you buy breakouts? I have been blue in the face listening to classes that teach you to buy breakouts. You can't, because there's no guarantee of a trend continuation. Based on the average true range of the instrument, you may look for a 25 or 30 cent move on a stock, or a 10 or 15 tick move on a future, or a 10 or 20 pip move on a Forex market, and it just doesn't get there, and it just comes right back and stops you out. Nothing can guarantee a trend continuation. If you buy reversals, you are really going to go bankrupt incredibly quickly. And the reason is that trends are created by the institutions. They're not computer-generated high-frequency trades, but in general, the flow of institutional money creates the trend. And if you trade against them, you're really, really going to get hurt. The goal of this class is to teach you to recognize an institutionally driven trend and to get us in early on what we call a trend continuation signal. If you do this with precision, the predictive value of a trade continuation signal in a multi-time frame trend can be as high as 90%. So we never trade against institutional money. We trade with it. We leverage big money. This is how I trade options. I use institutional money. I use a multi-time frame trend in order to guarantee a trend continuation in the instrument that I'm buying the option on. Now, here's a trend continuation in an institutionally created move. This is our longer term moving average, it's red. This is our shorter term moving average, it's red. You can see that the financial instrument, doesn't matter what it is, it moves to the downside. This B candle are the counter trend traders, all the losers. They're deciding that this is a market bottom, that this financial instrument is not going to move down anymore, and this B candle is an up candle. And they're in for, they're in for a rude awakening, because when this occurs, this move is most likely institutionally driven. And what we want to do is we want to take the close of the C candle one tick below and ride the institutionally driven move to the downside. That is a low risk, high reward trend continuation trade, leveraging the direction of institutional money. You'll see in this move down, here's a counter trend trader. He's run over. Counter trend trader, run over. Counter trend trade, two of them, run over. Anytime the institutions bring their money to bear, we want to trade in the direction with them. This is not a high frequency generated computer dropping the market, because they don't create pivots. They just blow the market down, seven candles in a row. We get the ability of the small commercial guy to create a counter trend candle, and we let the market run them over. This is what we're going to teach you how to get into. The trend continuation signal. We are not going to guess at a bottom or guess at a top. You know when the bottoms occur? When the institutions say they're the bottom. They're not when an oscillator says it. They're not when a stochastic says it. They're not when relative strength says it. They're not when Williams-K says it. It's when the institutions step aside. That's when the bottom occurs. And we're not going to try to counter trend against the direction of institutional money. Now again, I'm just digressing because I really want, this is an important point. Your trade management strategy, your stop is based on market structure and has never moved intra-trade. To minimize risk and optimize profit, you should scale out of a trade. And our targets are set by the average true range. And the trailing stop is set by the average true range. As the trade moves up in your direction, you want to pull that stop up to increasingly lock in more and more profit. If the stock moves to the to the peak of its average true range, you're out of the trade at maximal profit. But if it comes back to stop you out, it's going to stop you out at a point where you've locked in a nice amount of money on that trade. That's mitigating risk and maximizing profit and how you gain profitability. Now let's look at retail traders versus institutional traders. Now retail traders create volume not associated with a brokerage or a fund. And institutional traders, we know, they represent large amounts of capital. They're extremely aggressive and they leverage huge amounts of money. It's just impossible to trade against them. But I see counter trend trading recommended all the time. I see trading tops and trading bottoms recommended all the time. And this is why so many traders fail. Now, there's a misnomer that stocks without a unique fundamental catalyst to draw in institutional traders are difficult to trade. That is totally wrong. A stock in a multi-time frame trend in which the trend on multiple time frames align is trading with institutional money and doesn't necessarily need a catalyst. So you can, when we set up our scanners, one of the variables we look at is for the multi-time frame alignment of trend on any financial instrument we're looking at, whether it's 100 stocks or 12 Forex markets or 12 futures markets. That's one variable we look at to be in our favor. And the goal, remember, this is something that's really important. There's a global linkage of all asset classes. And another goal that we have, and I'm going to show you how to do it. Once you see how to do it, you'll find that it's not that difficult. But our goal is to track the flow of institutional money from asset class to asset class. If we can do that, we can trade with tremendous precision. Now, it's easily done with the use of algorithms. And at the end of the class, I'm going to show you an algorithm that does it for you. But I don't want to give you a crutch. I want to make you do it on your own. Before at the end of the class, I give you an automated method. What I want you to do is learn how to track the flow of money from asset class to asset class. And it also helps to be in a chat room with hundreds of like-minded investors. They help you track money just by talking in the chat room. And I'll show you. Here's a 3-minute chart, and here's the trend. Doesn't matter what this is. This could be Google, Netflix. It could be the E-mini S&P. It's irrelevant. Here's the 9-minute. Here's the 27-minute. Now, when this first occurs, this is because institutional money is flowing into this financial instrument. And if we can catch that flow into this instrument early, when these time frames first align, then we can leverage this move all the way to the top and do it with very low risk, because we're trading in the direction of a multi-time frame move that's generated via the use of institutional money. And this is a big asset class rotation out of one group of financial instruments into this financial instrument and some additional financial instruments. It may seem esoteric and obtuse, but I'm telling you, it's very clear. So we start the day at about 8 o'clock, and we do use scanners. We have to use really accurate ones. And we look for stocks or futures or Forex markets in play. And those are the ones galvanized by news, and we create a watch list. We do have powerful algorithmic scanners, but we're going to learn how to create a watch list without a scanner. Let's do it on our own. Let's create a powerful list and trade off that list. Let other traders trade gaps, which is just a fad, and it is a gimmick. Let other traders trade momentum breakouts. Let other traders trade HOD, high of day breakouts, and take reversal trades. We're going to focus on the trend continuation trade in the direction of institutional money. And let me tell you why gap trades are so bad. A gap is created by a buy-sell imbalance that occurs pre-market. You know, let's say it's a small biotech. We don't even have to name it. And it closes at 20. And there's a huge amount of news pre-market that one of their biggest medicines was given FDA approval in a phase 3 study. So there's a tremendous amount of buy orders waiting when this stock opens. So it closed at 20 and it opens at 22. Now that buy-sell imbalance is going to continue throughout the first 5 or 10 minutes that stock trades. And it's really just a guess as to what direction. Whether if it's a long gap, it's going to sag and then continue back to the upside. If it's a short gap, whether it's going to pull up and then continue to the downside. You cannot trade a gap appropriately because you need multi-time frame alignment and you need trend continuation. It appeals to people, but on balance, I'm telling you, when you're selling market, When you're trading market instability, you're looking for trouble. What you're looking to trade is a market multi-time frame alignment of trend, the exact opposite of instability. We're looking to trade a multi-time frame trend or a supreme area of stability. Breakouts also and reversal trades are not going to get you there. They're gimmick setups and they're taught by non-traders. The important thing is to trade the morning session that runs on high volume with institutional participation. The reason you need the volume is because everything we trade is based on market sentiment, market structure, price action, even indicator analysis. It's all market. It's all all different metrics of market sentiment. We need to have a lot of traders creating the sentiment. When there are hundreds to thousands of traders creating that bullish sentiment, we know that sentiment isn't going to abruptly change. When there's 9 traders on really thin volume creating bullish sentiment, all it takes is one guy to step in with a huge sell order to throw you right out of the trade. So you can't trade during light volume periods. That's what the volume hammer helps us do, because it's showing us the number of shares, contracts, or lots that is crossing per unit time. And when the volume hammer is sitting at the bottom, just lying there like a lump, doing nothing, we have to stand down or we're going to get hurt. The charting software, there's a lot of good ones. It depends on what you trade. eSignal, TradeStation, Thinkorswim, NinjaTrader. NinjaTrader is what I use. It's a great charting package for futures. I also use Thinkorswim for stocks and for options. Level 2 data is required. Like I said, I recommend trading range bars and not time bars. I do not use any standard indicators on any trading platform whatsoever. They utilize data from your trading chart and they have no forward-looking ability. If you bring any indicator down from any trading package whatsoever, it's simply going to hurt your trading. Now, scanning tools provide you with a way to find stocks, futures, and Forex markets that align with what we're looking to do. Our scanners don't look for rising triangles or falling triangles. They don't look for pennants or consolidation. They look for the multi-time frame alignment of trend to get us into a trend continuation trade in the direction of institutional money. When our scanners go off and we pull up a market, we're likely to get a low probability, a high probability entry winner, a high probability winner, sorry. And like I said, we have a scanner that looks at multiple independent variables that predict future price movement. When the alignment occurs, there's a visual audible alert. But I'm not looking to teach you how to read a dot that's flashing. What I want to teach you how to do is to find these instruments on your own. Because when you do, you're going to be really the trader that you want to be. You're going to be independent, you're going to be professional, and you're very likely to be very profitable. Now, I've seen a lot of people in a lot of courses say, hey, Joe, are you good at spotting reversals? Hey, Sam, are you good at spotting breakouts? And, you know, hey, Mike, are you really comfortable with that 3-minute, 9-minute chart? Well, find a strategy that's good for you. Well, that is the recipe for disaster, because you don't find the strategy that's good for you. You make the strategy that works work for you. This isn't about you becoming comfortable with the way you want to trade. It's becoming acquainted and practicing with the way that you have to trade in order to make money. So throw this all away, because they're just teaching you some easy stuff to get you to buy something. And if they're going to tell you, well, you know, trade what's comfortable, trade what's easy, trade what you like, find a strategy that works for you, you're going to get bruised. You can't do it that way. Just like that 3-to-1 risk to reward, it's not going to work. So you must trade a strategy with a defined predictive value, and you have to track your performance on a spreadsheet because it really helps you to look at every winner you take and every loser you take in the evening. Now, in this class, I'm going to give you a lot of homework. I'm going to give you a lot of exercises, and you're going to turn your homework into me because I want to see that you know what's going on. I want you to show me that you can find setups as the class proceeds. It's a 10-week class. They're going to get more and more complex. You're going to turn in homework every week, and I'm going to evaluate you individually. Now, here's the thing. It's a lot easier to do this digitally, to simply create 10 classes, put them on a link, blow them out to you, and let you watch each one of them at your own speed, and I don't have to do any more work. But I want to go the extra mile for you. I want to be in the room with you, talking to you. I want to see what your questions are and give you feedback. And I also want to be able to give you homework. If it's a digital class, if it's a pre-recorded class, you can't do that. You can't ask questions. And sure, you can email stuff to me, but it's a lot better to have me in the room with you, talking to you, so that if there's a problem that you have, I can answer it for you on the spot. And I'm going to give you homework assignments every week. And if you want to become a professional, profitable day trader, you're going to have to work, and I'm going to make you work. Because I'm going to grade your homework, and I'm going to have all of your email addresses on a spreadsheet. I'm going to see who's turning it in and who's not. And if you want your graduation present, you better turn it in. And I'm just kidding you, but the volume hammer is your graduation present. And if you do all the work, I can promise you that I'm going to lay that foundation for that 65-story building, so that when the rest goes up, it's going to sit on a foundation that's so deep and so powerful, it will last you for the rest of your life. Now, this is the class. It's a 10-part series. It's 60 minutes a class. It meets Wednesday at 1 to 2 p.m. Eastern Time. Now, if you can't be in the class, you don't have to worry. Now, because the fallback is if you can't be, it's better to be there. But if you can't be, all the sessions will be recorded and provided to you on a closed link. You're the only person that's going to be able to see them. You'll have that link available to you forever. It's not going to be closed out. You purchase the course, it's your class. We're going to spend 3 sessions on learning how to trade price action. It's the least understood and most important component of day trading. And it's the part of day trading that most market mentors don't teach you because it's the toughest to learn. But like I said, it's the most important and forms the foundation for everything that we do. Classes 4 and 5 are going to be to combine price action with market structure. If you don't know exactly what that is, you'll find out. What we're doing is we're adding specificity to the trades. If you just trade with price action alone, the rising and falling triangles, the channels, the pennants, you're going to get great winners, but you're going to get a lot of big losers. We're going to start to filter. So 4 and 5 is going to be price action and market structure. Now, I left out volume, but 6 is trading volume. 7 is price action plus market structure plus with indicator confirmation. Confirming your trades that you know are accurate with price based on price action and market structure with indicator confirmation is easy. I'm going to show you how to track institutional money. I'm going to show you how to track the flow of institutional money from asset class to asset class, and you're going to be able to do it deftly, quickly, and really well. And then parts 8 through 10 are trade management strategies. These are the things that are most often neglected. How to set up a trade management strategy that if you take a great trade, it allows you to milk it. Make the most money you can. Let me just tell you one thing about the importance of a trade management strategy and why it's so important to optimize it. The only way I liken trading stocks, futures, or Forex to like trading craps in Las Vegas, and obviously you know they're completely different, is that the longer you trade, the longer you're at risk. And what you want to do is you want to make your money, get your 2 or 3 successful entries, milk them for all they're worth, and get out with your 500, your 600, and how much you make depends on how much you trade. If you trade 1,000 shares, you're going to make a huge amount of money. If you trade 100, you're going to make a smaller amount. If you trade 2 contracts, smaller. 4 or 6 contracts, bigger. The magnitude of the amount of money you make is irrelevant because it's simply dependent on the amount of money you risk. What's relevant is the precision of your trading entries. How many of the trades are successful? How many of them hit your first target? And how many of them render you profitable? That's what's important. And that's why you want to milk every trade that you can, because you want to get your entries and you want to get out. Because as the day proceeds, the institutional participation falls off, commercial traders fall off, volume wanes, especially today in these markets today. I don't know what's going on. But you know, after 11 p.m. Eastern, 11:30 p.m. Eastern time, the markets die. We need to make our money early, and if we get 2 winners, we need to make a lot of money on them and get out. I'm going to show you how to do appropriate market scanning and to do it on your own without the help of algorithmic systems. And then you and I are going to trade live markets together. We will schedule times in the morning where we're going to meet. If everyone can't agree, we'll do it in the afternoon. It's a lot tougher because volume is low, but I want to trade a live market with you. We're going to do it on Sim. We're not going to trade anyone's money, but I want everybody in this class to take live trades with me, and I want to critique them so that when you finish part 10, you are going to know how to read price action, market structure, indicator confirmation, set up a trade management strategy, understand how to do market scanning, how to track the flow of institutional money from asset class to asset class, and you will have traded a live market. It's very comprehensive. It's a lot of work for you. It's a lot of work for me, but it's going to be very rewarding for you. Now, I could have sworn I put in the offer. Let's hang on one second here. Yeah, here's the offer. Oh, here's the class. And here's with volume. Now, the course is usually $988. We're offering it until 4:30 for $494. It's 50% off. And you're going to spend a lot of time with me. We're going to get to know each other really well. And if you do a good job and you graduate, you're going to get that free indicator. You're going to get the indicator at the end. You're going to get the volume hammer. It's a tremendously powerful indicator in helping you leverage volume. So that's really it. Let me see if there are any questions. Here we are at rightlinetrading.com or info@rightlinetrading.com or 1-855-765-6681. And you'll notice I haven't said a few things like trade 20 minutes in the morning and you can make $500,000. You know, spend 30 minutes learning this one strategy and you'll become rich. You know, if you can click a mouse, you can make money. Because it's not true. If it was true, 95% of day traders would not go broke. It takes work and it takes effort, but I am telling you, it's an achievable goal. And there is nothing better than being able to day trade profitably. You can do it for the rest of your life. You can do it in front of your computer. You can do it without a headache. You can teach your kids how to do it. You just have to start with the nuts and bolts. And let me tell you, there's one thing that you have to have that I can't teach you, and that is you have to have the temperament. You have to have the personality. You have to have an incredible amount of patience. You have to have a low frustration level. You can't overtrade. But these things all come with time. So let me see if there are any questions. Okay, next we're going to be available on Sierra Charts by the end of this month. And we'll also be available on NinjaTrader 8 by the end of this month as well. Okay? That's where we are. Sergio's working on both of those like I'm beating him with a whip. And I have a lock and key on his office, so he can't get out. And he doesn't get fed. Absolutely, Dave. Thinkorswim, you can trade any kind of bar. You can trade any of those. No, I'm not kidding. So you can definitely trade range bars on Thinkorswim. Thinkorswim's a very good platform. It's very powerful, and you can trade anything that I showed you on TOS. So no problem there. So listen, I hope we sure do, trader. We use market profile and we use order flow big time. These are the things, if you go back to the class, I'm going to show you. When we talk about indicator confirmation adds in market profile and adds in order flow. The system is extremely powerful. I took a trade this morning against order flow, and I handed myself a loser. And I wanted to beat my head against the desk. We trade with order flow only in that direction, and we trade with market profile. Those are extremely powerful components to trading, but we only look at them if price action and market structure give us an entry. If order flow is aligned in our direction and market profile helps us take the trade, we're in. So we definitely use them. Yes, it does. It'll work on anything on Motive Wave. NT7 or NT8, Walter, either one. Right now we're on NT7. We're going to be on NT8 shortly, but we're going to keep both packages. So if you want NT7, you got it. If you upgrade to NT8, we'll upgrade for you for free. So either one works. This is a system that's software independent. It's the way to trade using price action, market structure, indicator confirmation, irregardless of what instrument you're trading or what package you're trading. So you really, I mean, any basic charting platform will do this for you. So I wouldn't worry about this now. What you want to learn is how to trade, and this is what I'm going to teach you. Well, let me see, Robin, there's an advanced course, but although this is a basic course, it really is very comprehensive. And the reason I call it a basic course is because I start with the supposition that you don't know anything. So I don't start off with, well, you know about range, you know about Renko, you know about oscillators, you know about this. I want to start you off basically as as you're just emerging from the womb and you're a brand new trader. So that's why I called it a basic class, because I don't want to make the supposition in this class that you've learned anything of value, unfortunately. Although a lot of you probably know a lot of good things, we're going to start from the basics and work our way up. We're going to dig a new foundation for you. And that's how I think is the best way to proceed. That's why I call it basic. You're going to find that by 10 weeks out, we're going to be doing some pretty difficult stuff because we're going to be trading live. And in order to trade live, you got to really have a good, not just fundamental grasp, but really a good grasp on how to leverage everything, including the flow of institutional money, in order to get you into a trade. So that's really why I call it the basic class. There is one that's more advanced, but I'm not sure you need to take it if you really understand what I'm going to teach you. No, trader. Renko is not. because Renko doesn't give you wicks. And Renko doesn't necessarily get you out of at the high of the candle or the low of the candle. It can take you out off the high, 2 ticks over and out and start a new candle. So Renko is not range. Range is real different. Renko has 2 inputs, like a 4-2. A standard Renko is just a brick, but the more advanced Renkos have 2 inputs. It's price-based, correct, but it doesn't give you enough information to create market sentiment. This is what you need for market sentiment. You need that wick. I mean, when you have a doji, you need to know it's a doji. You can't read consolidation off of a Renko chart. It's impossible to get. You need to be able to read consolidation where the power of the bears and the power of the bulls is equal. It's very important. Plus, many, I mean, this is a little known fact, but many indicators don't work on Renko charts that that are pushed under your nose. Oscillators don't work on Renko charts because an oscillator requires an open, high, low close of every candle in order to trace out an accurate percent K line. So because software developers don't really understand what they're doing, they'll put in a Renko chart, and below it they'll put in an oscillator, whether it's relative strength or stochastic or Williams K or the CCI, it doesn't matter. None of them work on Renko. You need those 4 parameters on every formation to get an accurate percent K. You don't get them on Renko. It does trace out sort of a MACD crossover, but it's not a very good one. Your best trades are time, tick, and Renko. Out of the 3, I like a time, tick, and range. I just like that the best. Heikin Ashi bars are fine if you want to trade them. They work because they do have tick. They do have a open, high, low close of every single candle. They kind of obfuscate that a bit because they have that attached momentum component, and that kind of obscures price action a bit. But Heikin Ashi is problematic, but you can read inside the Heikin Ashi, but it's just a little bit more difficult. I mean, what we did was, I mean, we have a really, I'm not going to open the platform, but we peeled Heikin Ashi momentum off of the Heikin Ashi bars to create a Heikin Ashi indicator and found that it had no predictive value whatsoever. Listen, I'll tell you that in 1 second, Walter. Tick bars work fine, FJ. Listen, I have a predisposition to range, but like I said, I can't make a strong case against not trading tick or not trading time. They both give you nice market sentiment, and because I believe that there are probably going to be some advocates of time and tick, we'll do the class in time, tick, and range. And all of these principles work fine on these types of candles. There's not a problem with them. I can't make a good case against tick. In fact, there's a lot of stuff in the literature about how well tick charts do. I just happen to like range better, but tick charts will most definitely work for you. I can't be so dogmatic as to say if you don't trade range, you're not gonna make money. If you can apply these principles to tick charts, you'll do fine. The same thing with time, but not, in my opinion, not Renko. Now the class starts I didn't put the day in. It starts a week from today. I'm sorry, it starts the 10th of May. Not this Wednesday is the 3rd, 6, 7, 8, 9, 30, and then it starts 1 week after that. I'm on part 8. I've got to get to part 9 and 10. Then I'll have the whole 10-part series done, and so it's going to start in about a week and a half. You're going to have a little bit of time to prepare. I'm going to send you some e-zines and some written material. I'm going to prep you before the class. Hey, listen, FJ, this is what we're trying to do in this class. I'm trying to give you I'm trying to make it so that you have an edge over all other commercial traders. We're never going to have an edge over the institutional guys, and we're not going to challenge them. But why can't we as a collective, everybody in this webinar, and there are a lot of people in this webinar, and me, take the money away from the other small guys? It's ridiculous that we should give our money to them. These are the same guys like us. They trade a 2-lot, a 4-lot, a 6-lot, and if we don't ever trade against the commercial guys, the institutional guys, which are creating the trend, in which we're calling tops, calling bottoms, counter trend trading, we never challenge a multi-time frame direction and trend. We just trade with it, i.e. we trade with the flow of institutional money. Why can't we beat up those other little guys? And we should. We should be able to take home money from them almost every day. And that's the goal of this class, is to give you the not just the bare bones, but all the way up to the live trading ability to leverage their mistakes. And they're right here on every single chart. This is, I can't remember this is a minute chart. And you can see counter trend, counter trend, counter trend, counter trend, counter trend, counter trend. Nice consolidation, breaks to the upside, a retracement, but not a break and a move back to the upside. You can't counter trend trade a multi-time frame move, or you're going to lose. And that is shown in every single multi-time frame move. If we trade in the direction of it, we're always going to make money. Or almost always. I don't want to say always, always. We are commercial traders, Rob. We're not institutional traders. We're the small commercial. We are the small. Well, retail traders and commercial traders, to me, is the same thing. There's institutional traders and there's commercial traders. I mean, I think I look upon commercial traders. Well, listen, I don't want to get hung up over that. When I speak a commercial trader, I'm just talking about the small guy. I use the term institutional trader for the big guy. I use it, maybe retail trader is a better term for it, but I'm just looking to trade as the little guy, the retail trader. We're looking to take money from the other retail guys, and there's no reason why we can't. Somebody's going to take it because they're giving it away. Why can't we be the ones who take it? If they counter trend trade, and if they try to call a reversal in the middle of a multi-time frame trend, someone's going to take it from them. It might as well be us. So listen, I hope you enjoyed the webinar. It's a brief overview of a very, very detailed class. And I've listened to a bunch of them, from 6 parts to 9 parts to 10 parts, and they're just filled with so much fluff and so much incorrect information. This is really bare bones stuff, and every hour you're going to get a lot of info, which is the reason why you're going to have to do homework and return it to me, and I will return every JPEG of every homework that you send me. I will sit every night and work on it and type my comments on it and return it to you. So I want to make you a profitable trader, or one that takes money away from these other small guys trading in the wrong direction. So listen, everyone, have a great afternoon. I hope to see you in the class. If you sign up, you're going to immediately start getting information about what to read. I'm going to send you some e-zines that I made up about this class. They're real good. And I'm going to give you some preparatory work so that in a week and a half when we start, you are ready to rock. So have a great afternoon. Hey, you too, Ness. Take care, everyone. Have a great afternoon, and I hope to see you there. Bye-bye all.